Part 3. It's all about matching, when spending becomes expense. Last section, we saw that revenue and operating expenses, or OPEX, aren't always recorded when cash moves. They follow the matching principle. Expenses are recognized in the same period as the revenue they help generate. But what about investments in equipment, facilities, vehicles, etc.? Or inventory purchases that will only turn into sales later? In this part, we'll explore two more categories of cost: CAPEX, or capital expenditures, and inventory. Unlike OPEX, they don't materialize as expenses immediately. Instead, they follow a delayed path to the income statement. CAPEX leads to depreciation, while inventory becomes cost of goods sold, or COGS. Yet they still follow the same basic rule: match the cost to the benefit. CAPEX, not OPEX, not COGS, but still matching. Capital expenditures are large, long-term investments like buildings, machinery, or vehicles. These are not operating expenses, and they're not part of COGS either, but they still need to be matched to the periods when they help the business. Let's take VanCat. The company buys a brand new electric delivery van for $60,000. The van will be used to serve catering clients and festivals for years to come. It's clearly an investment, not just a cost for this month. But VanCat doesn't record the full $60,000 as an expense in the year they buy it. Instead, they consider the vehicle as an asset and spread the cost over the van's useful life, say $6,000 per year over 10 years. It's called depreciation, and it's a non-cash expense. So why can't you just expense the full cost of equipment when you buy it? Because it would distort the financial picture. The van will support the business for years, so the cost is spread out to match that benefit. That process is called depreciation. Key point: depreciation is a non-cash expense. VanCat paid for the van up front, but only a portion shows up as an expense each year. The goal is to match the cost to the revenue it helps generate. Inventory. Like CAPEX, it doesn't become an expense right away. Inventory works similarly. When VanCat buys ingredients for their sandwiches or pastries, that's not immediately an expense either. Just like the van, inventory sits as an asset, waiting to be used. The expense only appears once the sandwiches are sold. For example, VanCat spends $2,500 to buy cheeses and preserved meats for a weekend event. The full amount doesn't show up on the P&L on day one. Instead, if 300 sandwiches are sold, $1,500 becomes COGS. If the remaining $1,000 stays on the balance sheet as inventory and is unsold. Both CAPEX and inventory start their life on the balance sheet as assets. Over time, they move to the income statement as expenses, but only when they contribute to earning revenue.